Welcome to the deep dive. I want to start with something I think we all feel. You, the listener, you're smart. You've read the strategies, you know the basic rules for building wealth.
The math of it all.
Exactly, the math. So here's the question that I think keeps a lot of us up at night. If the strategies are so clear, why do highly intelligent people constantly make financial choices that, well, quietly sabotage their own future?
It's the central paradox of money, isn't it? If success were just a math problem, optimize this, minimize that, the world's wealthiest people would all be mathematicians. But they're not.
And that leads us to what we're tackling today. We're doing a deep dive into these hidden behavioral traps, really based on the principles from the psychology of money. And the core idea is simple. Money isn't just about logic. It's deeply, deeply psychological.
And our mission here is to pull out the key mindset shifts. Because here's the thing, intelligence doesn't protect you from these biases. Sometimes it just makes you better at justifying them.
At rationalizing a bad decision.
Precisely. So the goal isn't to become some coldly rational robot. That's not human, and it's not sustainable. The real goal is to just be mostly reasonable.
Because reasonable is something you can stick with. And we're going to find out that sustainability is maybe the most powerful force in finance.
Okay, let's unpack this. We can start with the biggest distortion of all. How our own pasts basically blind us to what's really happening. This brings us to, let's call it trap one. You think you're being logical. I mean, think about that classic situation. Two smart people looking at the exact same stock, the same numbers.
Same exact data.
And one person buys and the other one sells. And in their own minds, they're both making the perfectly logical choice.
Right, because they are. They're acting rationally based on their life experiences. But that experience is just a sliver of the whole picture. Everyone has these emotional scars around money.
Yeah.
Or maybe a huge windfall.
So a broker who got wiped out in the Great Depression is just never going to trust the market in the same way, no matter what the data says today. That scar tissue becomes their logic. And your personal experience with money, even if it feels universal, is maybe 0.0001% of what's happened in the financial world. But it shapes nearly 100% of how you see things.
So then how can anyone claim to have a universal strategy if everyone's experience is so different?
Well, you can't, not a specific one. You have to look for the broad, durable patterns. I mean, someone whose family lost their house in 2008 might see mortgages as pure danger.
Forever.
Right. But a millennial who only remembers the low interest rates after that might see it as the greatest opportunity ever. Neither view is mathematically wrong, but they're playing two completely different emotional games.
And that idea, the game we think we're playing versus the one we're actually in, that feeds right into trap two. This illusion that we are fully in control.
Oh, this one is huge.
We love the story that success is earned and failure is deserved. We conveniently forget about the massive role of just pure luck and risk.
It's a huge adjustment to make. Success is never just effort. It's always effort plus luck. And risk is, by definition, the part you don't control.
The book uses the classic example of Bill Gates. And yes, of course, he was brilliant, strategic, but he also had the incredible random luck of going to one of the only high schools in the entire country with a computer terminal in the early 70s.
Unbelievable luck.
That one thing gave him a head start that was basically impossible for anyone else to get.
And then you contrast that with his friend, Ken Evans, just as brilliant, just as obsessed with computers. But he died in a mountaineering accident before they even graduated.
Wow.
Same talent, same drive. One random, tragic event. And the financial outcomes are worlds apart. It had nothing to do with skill.
That's a gut punch, really. The takeaway is just so profound. You can't take all the credit, but you also can't take all the blame. If you only idolize these extreme successes, you miss the unrepeatable luck that was involved.
So instead of trying to be the next Bill Gates, you should study the patterns that help you survive the bad luck when it inevitably comes for you.
And if we can't trust our own context or the story of control, we fall into trap three. You believe the story, not the cold, hard reality.
We get sucked in by what the book calls appealing fictions. These are narratives that they feel good, they're simple, they're exciting, but they quietly lead us astray.
It's focusing on the outlier.
Yeah.
We hear about the one person who won that $200 million lottery, that 1 in 300 million story.
Because it's a dream.
It's a dream, and we ignore the millions and millions of people who just lost their money.
We saw this play out perfectly in the late 2021 crypto boom. People were not buying the technology, let's be honest. They were buying the story sold by influencers.
The story of getting rich quick.
The Lambos, the early retirement, The warning signs were everywhere. I mean, coins with zero utility, founders vanishing, but the story just felt too good to question.
So the question you have to ask yourself every single time is simple.
Yeah.
Is this based on data or is it based on desire? Do I believe this because it's true or just because I really, really want it to be?
Okay, let's move into our second big area, which is what I call the sustainability challenge. This starts with trap 4. You think you're a spreadsheet.
Right. We try to plan our finances like we're these rational machines, but we're human. Spreadsheets don't get jealous of the neighbor's new car.
Spreadsheets don't panic sell when the market drops 30%. We do.
Exactly. So if you build this perfect, mathematically optimized plan, it's just going to shatter the second real human emotion gets involved.
And that's why being mostly reasonable just works better. Reasonable is the plan you can actually stick to when you're stressed out. And sustainability, that ability to stick with it, is what really builds wealth over the long haul.
Let's put a number on that. The data says the stock market, over any 20-year period, has a 100% chance of delivering positive returns. That's the math.
It's a fact.
But that fact means absolutely nothing if you get scared and abandon the plan in year 10.
The real threat isn't bad math, it's bad emotions.
Yeah.
And that leads to a huge one, trap 10. You want the gains, but you don't want the ride. Investing is not free.
Right. The price isn't in dollars, though. The price is paid in stress, in doubt, and that feeling in your gut when you see your portfolio just plummet.
You have to see that volatility as a fee, not a fine. It's not a punishment for doing something wrong. It's just the price of admission to a game that can generate incredible wealth.
Wait, so if it's a fee, does that mean we should literally budget for a big market drop every few years, just like we budget for taxes?
Precisely. If you expect the crash, if you've planned for it, it's no longer a shock. And it doesn't force you into an emotional decision. Look at Netflix. It returns something like 35,000% over 16 years.
An incredible number.
But to get that return, you had to endure the stock being below its all-time high for 94% of that time. You paid the fee by living with constant discomfort.
And if you spend all your energy trying to avoid that short-term pain, you just end up losing out on the long-term game.
Which brings us to traps 11 and 12. The need for defense and planning for failure. Getting rich, that's offense. It takes risk. But staying rich, that's all defense. It's survival.
Because a strategy that only works when everything is going perfectly is, well, it's not a strategy, it's a fragile bet.
Absolutely. You have to build in a margin of safety, extra cash, diversification, things that don't maximize your returns, but maximize your ability to survive a crisis. This is trap 12. The most important part of your plan is planning for the plan not to go according to plan.
I love that Benjamin Graham idea, that the whole point of a margin of safety is to make forecasting unnecessary. You don't have to predict the recession if you know you can survive it.
Your plan fails when you break, not when the math breaks. We focus so much on financial resilience, but it's emotional resilience that actually keeps you in the game.
Okay, this is where it gets really interesting for me. Let's shoot from the markets to ourselves. Let's talk about the lifestyle traps that get us even when we're doing everything else right. So, trap 5. You chase more than you need. The rule is so simple. There's just no reason to risk what you have and need for something you don't have and don't need.
And yet, people do it all the time. The goalpost just keeps moving. The tragic example here is Sam Bankman-Fried, worth $20 billion at 29.
An insane amount of money.
He wasn't risking customer money because he was broke. He was risking it all for more. More status, more power. It's the never enough monster.
And it's all rooted in comparison, which, as Bertrand Russell said, you can't win. You get to one level, you just start envying the person on the next. I mean, Napoleon envied Caesar, Caesar envied Alexander.
And Alexander envied Hercules, who wasn't even real.
Right. It's an unwinnable game.
The only way to win is to stop playing, to define what enough means for you. And once you do that, you protect yourself from the massive cost of what we'll call status signaling.
Which is trap 6 and 7. Trap 6 is the man in the car paradox. You buy a Ferrari hoping people will admire you, but when someone sees it, they're not thinking about you.
They're imagining themselves driving it.
Exactly. No one is as impressed with your stuff as you are. If you want respect, money is a terrible tool. Humility, kindness. That's what people admire.
And trap 7 cuts even deeper. Looking rich versus being rich. Spending money to show people how much money you have is the fastest way to have less money.
We see the car, the house. We don't see the brokerage account. True wealth is invisible.
It's the assets that haven't been turned into stuff yet. It's the financial capacity you chose not to use. The paradox is that most bad financial decisions come from trying to look rich, not from trying to be rich. Building wealth is quiet. It's boring.
Speaking of quiet moves, let's talk about Trap 9, the simple power of saving. You can't control the market,
Mm.
but you can 100% control your savings rate. And saving is really just the gap between your income and your ego.
Oh, that's so true. Think of the high-earning lawyer making $250K a year. The lifestyle immediately expands to match. The Porsche, the huge mortgage, the fancy dinners.
They have a high income, but zero wealth.
Zero flexibility. One emergency and the whole house of cards collapses,
Wow.
all because they traded security for status.
So what's the point of all this saving and defense? It leads to Trap 15, the ultimate prize. And it's not stuff, it's freedom over your time.
Research backs this up completely. A famous study by Angus Campbell found that having control over your life is a much stronger predictor of happiness than your income or your net worth.
The highest form of wealth, the real trophy, is waking up in the morning and saying, I can do whatever I want today with whoever I want for as long as I want. That control is the real payoff.
So let's shift to the really long game. And that starts with avoiding Trap 8, falling for pessimism.
Bad news is loud. It's urgent. A market crash will dominate the news for a year. It feels like wisdom to be cautious.
But progress is slow. It's quiet. 140% gain over 6 years barely makes a headline. That's why pessimism always sounds smarter, and optimism can feel naive.
But real optimism isn't just blind faith. It's knowing there will be setbacks, but believing in long-term growth anyway.
The key is to just zoom out. Look at decades, not days. The U.S. economy has survived wars, depressions, you name it. Yet our standard of living is 20 times higher than it was 170 years ago. Optimism is the only rational long-term stance.
And that long-term view is essential for Trap 13. You underestimate the power of time. Time, not timing or talent, is the most powerful force here.
The ultimate example is Warren Buffett. His net worth is somewhere around $160 billion.
An unbelievable number.
But over $156 billion of that was earned after his 65th birthday. His success is a story about time. It's about getting a good return and just sticking with it for a very, very long time without blowing up.
And that connects to maybe the most mind-bending idea, Trap 14. Success is driven by tail events.
Yes. Most of what happens doesn't really matter. Most of your returns will come from a tiny handful of rare, powerful events.
That's the key insight. You can be wrong most of the time and still get rich, because one huge win does all the heavy lifting. Buffett's fortune came from maybe 10 key stocks. And get this, since 1980, just 7% of all public companies drove all the net gains in the market.
Think about that, 7%. It means the other 93% were basically noise, a wash.
So your goal isn't to be right all the time. Your goal is just to stay in the game long enough to catch one of those rare winners, which is why diversification and patience are so important. Finally, let's talk about protecting our future selves. Trap 17 is the end of history illusion. We radically underestimate how much our own goals are going to change over the next decade.
What feels critically important to you at 25 will seem irrelevant at 45. So the solution is to avoid extremes. Don't sacrifice everything for wealth, but also don't live so frugally it makes you miserable. A moderate plan is a flexible plan. And a flexible plan is one that survives when you inevitably change your mind about what you want out of life.
And the last major trap, number 18, playing the wrong game. You absolutely cannot be persuaded by the actions of people who are not playing the same game as you. A day trader's moves are irrelevant to a long-term retirement investor.
Financial comparison is so dangerous because it's always stripped of context. You see the purchase, but you don't see their timeline, their goals, or their safety net. You have to define your game and then just tune out all the other noise.
So after all of this, what does it all mean? I think it means that mastering your money isn't about solving some complex math equation. It's about solving the complex emotional problems inside of us. The highest financial skill is just staying calm and being durable.
Exactly. The biggest costs you'll ever face are the ones you never see coming. A health crisis, a job loss. Financial freedom isn't about being right about the future. It's about building enough space and flexibility into your life so that when things go wrong, and they will, it doesn't break you.
So we'll leave you with this. If the highest form of wealth is freedom over your time, what single habit could you stop or start today to give yourself just one extra hour of control tomorrow?